Hi, Greg Walden here with the Global Macro Strategy Report for Thursday, October 30th. Today, we're going to talk about the monetary punch bowl. If you recall, in the past, central banks have talked about part of their job is to pull away the punch bowl before the crowd gets too drunk and there's a hangover. You get a big rise in stock prices, stocks crash, there's a big hangover, in terms of how the economy progresses based on what the markets do. It's really interesting that this is the dynamic I chose today, especially after the press conference from Chairman Powell yesterday, which we are going to go through word by word. But the fact that they basically said we're not going to cut rates again in December, or at least, we're far from, confirming that that's on the table here as a given, really set back the Fed funds forward markets, all right, and sent the bond market reeling, and yet stocks made new highs on the opening. This is not kind of consistent with the way I see it, which is that the Fed, by falling further behind the curve, means the economy will weaken more dynamically in a more pronounced way. And that means, labor market, layoffs, and a whole kind of things. We just saw Amazon laid off 30,000 people. And the Fed's like, well, we don't see it in the claims data yet. They're waiting for the whites of their eyes. No, they're waiting for the enemy to be right on top of them before they're going to try and fire their weapons. And then by that point, it's hand-to-hand combat. And the long-range rifles are going to do no good. So they're behind the curve. This sets them further behind the curve. They're not neutral yet. They want to get more neutral with this cut, but then talk about where neutral is. There was a big discussion around neutral. Then talking about the differing opinions. And in terms of the division on the Fed, everything's divisive. Of course, the Fed's going to become divisive. I mean, you should have seen that one coming. So, all of this doesn't play negative for bonds to me. It doesn't become negative for bonds in the economic impact on the labor market, particularly when the consumer's already choking. It's not bearish on bonds to the degree that the Fed just said we're going to end QT. We're going to end the shrinkage program, which means less selling of bonds. So, it's kind of a supply side plus for the bond market. It's hardly bearish, all right? Watering down the punch bowl is not bearish for bonds. It's outright bullish for bonds. The Chinese-U.S. trade deal, there's no deal. We're going to kick the can down the road, and this is the biggest can that we kick down the road next to global debt and the U.S. public debt and the deficits. So, the second biggest one is our trade deficit. You got the Twin Towers, budget deficit, trade deficit. And we're going to kick the trade deficit down the road just like we are the budget deficit. It's not bearish for bonds. It's bullish for bonds because ultimately this causes problems, and ultimately it's very bearish for bonds, but not in the interim. Not when you see the curve flattening either, which, might say, well, that means the long end is going to lead the way higher in yields. I say no, just the opposite. It's bullish for bonds, all of this, in my opinion, particularly the trade deal, which isn't a deal at all. All right. And, I'm sure the media tonight on Fox are going to be championing Trump as the greatest thing. And he comes home with a gold crown that the leader of Korea gave him. How appropriate is that? In some ways, it's appropriate. In other ways, it's a sign of kind of this pompous, pomp and circumstance, I should say, but it's also pompous, but pomp and circumstance around, Trump and the way he acts, and that this is some huge victory and he's dominating the world and making trade deals all over the place. Japanese trade deal was in place already. All he did was meet the new PM. The Korea trade deal, well, Korea is a country that really does need it. Malaysia, under attack from China a little bit. So the degree to which this becomes some big deal that's going to set off another big rally in stocks, no. All right, a reality check. Because this market in stocks, consumer not leading. Housing not leading, employment and labor market in big trouble. So again, to me, energy's not leading. Home builders are not leading. The material sector is not leading. Not even the banks and the financials are leading anymore. It is all just chips and high tech, and this has gotten about as far as it can go, as far as I'm concerned. And I think that we see reversals here on a short-term basis, which could become real big signals when we look back at what we see tomorrow and Monday. Could be really interesting how this plays out. Let's get to the Fed.